Joining us this morning on Studio 10 is financial expert Dale Gillham. Hi, Dale. Hello.
Finance expert Dale Gillham from Wealth Within. It's nice to see you again.
It's amazing listening to a professional trader who's doing what you're aspiring to do and hearing it firsthand.
Too many people ring me up and say, hey, Dale, I want to make quick money, but it's not about getting rich quick. I think we can go for about 4 hours, but I'm not sure my wife would like that. So
I'd say congratulations for putting your time and effort out there, because you probably don't really have to do it. You're successful traders in your own right.
Thank you very much for opening up my mind with trading.
So of course you can succeed, of course you can, and you're the only one holding yourself back or succeeding, and that feels very empowering actually.
A quick reminder before the show starts that this live stream is an educational tool, and as such your personal circumstances have not been considered. We hope you enjoyed this week's show.
good evening and welcome to Wealth Within Live, the Australian stock market show where you get to ask the questions and we give you the answers about all things trading and investing. If you're interested, tonight what we're looking at here is the coronavirus, and obviously I hope you've had a really great day. And I mean, the stock market is a little bit volatile at the moment, and I know a lot of people are panicking, so we're going to handle that tonight. And obviously our topic for tonight is mass panic on the stock markets. That's what you want to get into for the topic for tonight. As you can see, Janine's not with me at this point in time. She's actually not feeling really well tonight, so I told her to stay home rather than come out here and disrupt herself. She's got a bit of a cold. No, she doesn't have the coronavirus, guys, but what actually happened is I was able to throw out that swear jar she gave me last week, so that's now in the rubbish, so hopefully she doesn't find it. But as always, we'll look at what's currently happening on the Australian market. We'll look at your questions or answer your most burning questions, and what we'll do is we'll get into the stocks that you'd like to me. So if you do have a question, make sure you put your comments in the chat on the right of the screen. So have a look at that. But for now, what we'll actually do is we'll get into, it's the second Tuesday of the month, which that means we're actually going to get into the sectors on the Australian market. So let's go and have a look at the charts of the sectors, and we'll have a little bit of a discussion about that right now. So if I can get the guys to bring that up, I'll go through to that now and we'll have a good look. Tonight's going to be a little bit disjointed guys, because we've had lots of little technical issues today. The market's melting down a little bit, and we've also got technical issues. My beautiful laptop that we've been using the last 2 weeks has decided not to work properly, and I've got little other issues with other things at this point in time too. So, but on your screen you should be seeing the sectors in the Australian market. Now this is the week, so if you see up there on the left hand side, that's the week or the results for this week from Monday. So that's Monday and Tuesday, so it's yesterday and today, and you can see how energy was hit very hard yesterday, and this is a lot of those energy stocks, Oil Search and Caltex, and those got hit very heavily. Obviously materials with BHP and Rio got hit as well, industrials, technology, but it's more important to look at the longer term move, not the shorter term move. Daily moves are pretty much irrelevant, and if you study the markets and you study some of the workings of Charles Dow, the founder of the Dow Jones, he actually say that daily fluctuations are irrelevant, and that's really what I teach my traders is daily movements are irrelevant. It's when you're looking at the bigger moves over the months and or several months and into the years, that's when you need to look at, or how you need to look at the market. So if we change this now to a monthly chart, and you'll see that the actual outlook is a little bit different for the month. So even though we're only 9 days or 10 days into the month, you can see our energy is still down at 20% there. But communication services, staples and healthcare aren't down by very much at all. Utilities only down by 2. Consumer discretionary information technology, they're down by less than 50% of what the market's fallen. To yesterday, I think the market had fallen about 20%. So they've only gone about half of the way, and even financials about half the way. So where is the big fall coming from? And that's obviously from on the energy sector. But if we take it back one more step and go to the year to date from 1 January, this is what we actually see here. On healthcare is up about 6.87%. Energy is down 34%. So energy was already going down. If we look at energy, you can see how the fall has been really going on. If I change that to a monthly chart, you'll see energy's all-time highs way back in June 2008, and it's really been sort of bearish since October 2018 and more recently since January. So it was already sliding. So when you see the market falling away, those sectors or the stocks that are already weak fall away harder because they're already in a fall. Stocks or markets that are more bullish will fall less. And so this is how I read these sorts of charts when we're looking at the sectors. Is I'm looking at some of the sectors that haven't fallen enough or haven't fallen very much because they're showing signs of strength. But then also look at some of these like energy. What opportunities are there in energy? Because normally a 30% fall really does pull up stocks, a lot of stocks and a lot of markets. So what we might see is some opportunities coming through here, but we will have a little bit more of a look at that as the time goes by. And I'm not going to bring up an All Ords chart at this point in time because I'm going to cover the All Ordinaries Index, and I'm going to show you some All Ordinaries Index charts when I get into our main topic a little bit later on in the show when I do discuss that, because to me the market conditions are now, and I know given the market conditions here, I know we do see a lot of people, there's a lot of fear in the marketplace, but what I find is that this time of the year we see, or this time of the market, what we actually see is a lot of individuals who are those armchair experts, those would-bes if they could-bes. They get out and, you know, they start really, I mean, you can see them posting on our YouTube, on my YouTube report from yesterday, my All Ordinaries Index report. You know, it's when you see my reports like, you know, stock market crashing, or you see things like, you know, the hot stocks on the market, find the hot stocks on the marketplace, more people look at those videos than look at the normal ones that we put out. And so they look at clickbaity titles, and these are the people that, you know, they really do, they really follow the herd and really what they're doing at the moment. And that's exactly what they're doing at the moment. Often they'll put comments onto posts like ours or videos like ours, and what they're actually trying to do is make themselves feel better about their lack of knowledge. Now, I'm not trying to be rude to anybody, but at the end of the day, we all here, what we're doing here tonight and what we do every single week with Janine and I is help people to learn. We don't make any money out of you buying and selling stock. We make zero money. We're not brokers. You don't trade through us. You can do whatever you like. And so what we're talking about week in, week out is really about how you can do better on your portfolios. Now, you know, to me is, you know, helping you understand the market a little bit better and helping you not panic is fantastic, and that's really what we're trying to do in terms of how we're actually working the marketplace and also how we manage portfolios and how we're managing the current volatility. But you know, you might ask why do people panic? And the simple answer to that is herd mentality. I mean, people are happy to watch videos, you know, and go to chat forums and get their hints and tips from those sorts of places, and while the market's going up, they're all fine and they're happy with all of that. But what actually happens when the stock goes against them, then they start blaming every single body else. They blame the market, they blame the experts, they blame everybody. And really, if you're panicking right now about the market, it's just a huge sign that you are not educated enough and you don't understand it. So hopefully tonight we're going to go through a little bit about, we're going to explain why I think there's a whole lot of opportunity in our marketplace at the moment. And I know Jen and I quite often will say, you know, this is our best guess right now based on our knowledge and experience. Now, we're not going to get it right 100% of the time. We never do. We never propose we ever get it right 100% of the time. And occasionally we get it wrong. And when we get it wrong, the market doesn't do what we expected, and then we just change our strategy. But one thing we've always said, Janine and I have said, doesn't matter whether the market is going up or down, we know what we're going to do. We have a strategy for either up or strategy for going down. And to me, that's really what's important, is knowing how you're going to react. It doesn't matter to us how fast the market's moving or what direction it's moving. We have rules around that. So if you don't have rules around that, then the issue is that you need to get some, because if you're scared of the market right now, then really it's something for you to look at and understand and ask yourself why you're scared of the market right now, because I do think it looks really, really good. But you know, to me, people tend to, as I said, blame everybody else and tend to make others look bad, or experts like myself look bad. I'm not the only expert that didn't expect the big move down. I expected a move down. I did expect a move at 8 to 12% down. I did expect it to move into this time frame. My charts have been saying a move down into this time frame. I just didn't expect 20%. But I still expect it to bounce. So whilst it has fallen further than what I thought, to me it really is a market not to be feared right at the moment. It's really to be embraced. But I'm going to have a look at a couple of things on the chat forum. I know there's a couple of questions there on the chat forum at the top, but I know my guys are having a lot of trouble with my teleprompter at the moment. I mean, my computer's not working, or my laptop's not working, and my teleprompter's not working. So, but hopefully that'll get fixed. But I want to read up a couple of questions that we do have. Masui, I think how you say it, I'm sorry. How can I buy upcoming floats? Really, with upcoming floats, my first question is why would you want to buy an upcoming float? I know 50% of floats, statistically, you can buy them after the float cheaper than you can off the prospectus on the float. But if you do want to buy floats, the ASX or asx.com.au, you just go to the ASX website. They'll have a list of upcoming floats in the next 12 months. You'll probably be able to click through to the prospectus. You'll be able to find out who is actually the brokers behind it. But generally, most people just get the prospectus either from the ASX or they go to their broker and say, hey, look, can you give me the prospectus for the upcoming float? So to me, that's really what you need to be doing to get into floats. But as I said, I don't necessarily recommend people get into floats. I don't buy them. Janine doesn't buy them. We'd rather buy them later on once the market's there and once the market understands what's going on. So, but let's have a look at the next question I've got. It's from William. He says, hi Dale and Janine, really looking forward to the show tonight. Have you seen the comments left on your last Aussie report? The amount of naysayers you had was pretty remarkable. And that's not uncommon. As I said, I have people in times like these, people come out of the woodwork, when times are good, they watch the videos, they like me getting it right 90% of the time, and then they make money from that. But then when it doesn't do what I think it's going to do, then they come out and then they're the naysayers, and that's okay, that's their journey. But again, that's human psychology. I mean, it was only a month or so ago, everybody was worried about the fires, everybody was helping out people with the fires, everybody was donating millions and millions of dollars through to the bushfire relief. And then, we see people arguing about toilet paper in the supermarket. I mean, human psychology is really, really, really different. But let's have a look at the next one. Tommy is the next question we got. He says, as an inexperienced trader, he says, I would like to know the strategy we employ to buy a share after a time of significant pullback. Do you still wait for the share to go up a while before diving in? Yes, we do. We've talked about falling knives all the time, Tommy. And Janine and I talk about this so often because people don't understand where the value of a share is, and they see a share falling away heavily and they go, wow, that was $40 2 weeks ago and now it's $30 or $20. It's cheap, so I'll jump in now only for it to find a little bit further fall and a bit further fall again. And so what's going on is at the moment the market is bearish. Yes, today it was up. I think it was up 2 to 3% today. But today is bearish, but it doesn't mean the move down has stopped. And that's really what we keep saying is whilst we think the market's going to do 8 to 12%, we're always prepared for it to not do what we expected. Late last year, the last 2-3 months of last year, or last 4 months of last year, I was saying I thought the market would get up to 7,200 points, possibly 7,600 points when it had its peak, and then it would fall away. I said if the peak happened earlier into 2020, then the downward move would be nice and orderly. If it happens a little bit later into this year, into February, March, then it's likely to be a little bit faster. I was saying that about 4 months ago. So that's exactly what's happened. But again, I didn't expect the 20% fall, but that doesn't mean it's not going to fall 25 or 30%. I'm not suggesting that. What I'm suggesting is you need to have rules around that. So right now the market's falling. It has been falling in the last couple of weeks. Stocks are falling. It doesn't mean you buy them. You need to make sure that they've stopped falling and start to move up before we buy it, because I'd rather leave money on the table and maybe 10 or 20 or 30% making sure it's going up before I put my money into it, because losing 20% is much worse than not making 20%. If you lose 20%, you've got to make more than 20% to break even. If you don't make 20%, that means you just don't make 20%. And so it really is about you buying stocks that are looking better. So let's have another look at another one. We've got everybody saying hello. Jacob saying, hi Dale and Janine. How are you? Do you think we've hit the bottom of this correction, or is there a little further to go? So what I'm going to do is I'm going to bring up a chart of the All Ordinaries Index just briefly. So let me go to that one, and I'll bring up my chart that I bring up each week. So if I look at that, let me just do a couple of things on here. Let me just get rid of a couple of things there, and we'll just bring that up. I just want to clean it all up for you. You can see here's the chart of the All Ordinaries Index at this point in time. Now at the moment we can see the massive fall down from that high, and you can see how big that fall is right down through there. It's 23.2%. But have a look, this is today's close. We're closing really up halfway on today's bar. So it opened up, pushed all the way down, and sorry, the weekly bar, sorry, not the daily chart, the daily bar. And so far we're half the way. So if I look at today's bar here, we can see here it opened, pushed down, and came right back. Now, I was only saying to Jim Beach, who I talk to every Monday from the US, and I said it wouldn't surprise me if our market closed higher in March than it did, than it opened. And what I mean by that is looking at going to a monthly chart and saying, let me just delete that. The monthly chart opened here at 6511, and I said it wouldn't surprise me if the close was above that, because I am expecting the market to move up, because markets always bounce, and that's what they always do. But if you see here, we haven't had a bounce yet. We've had quite a few days down. If I go to the daily chart, you'll see all these days down. Other than this day up and that day up, it's pretty much all red. So we do need to see a bit of a retest, and this retest will tell me whether this is the high and whether we're moving down. But and to me, we need to just confirm that. But again, I'll talk about it a little bit more once I get into my topic for tonight. So, but please do put your comments into the chat. If you're one of those people that just likes to, make stupid comments, just remember, this is an educational show, so please just make sure that you are doing something that's relevant to the show and asking, actually relevant questions for us, so everybody learns how to manage themselves during this time of increased volatility and obviously increased or heightened concern about the market. But before we move on, I just wanted to remind you of my live presentation that's happening this week here in Melbourne. It's in the city, so it's the presentation for the Australian Technical Analysts Association. It's on Thursday night, and they've kindly asked me to talk to their members. And what's exciting for everybody watching is that I'm allowed to invite you, and they've told me that you get a discount by mentioning Wealth Within. Normally it's $30 to attend, but you get to come to the night for $20, so that's pretty cool. The presentation is on Thursday. It's a couple of nights time, so the 12th of March, and the formalities, they do a bit of a meet and greet at 5 p.m, but the formalities really start at 6 p.m. with the presentations. I'm going to be on from 6:45 to 8 p.m. And it's at the Ibis Hotel in Theory Street near the Victoria Markets, which is, I believe, very easy to get to. It's near the train stations and there's parking nearby. But if you are interested in going, then you need to send us an email with your contact details, and we'll send you all the relevant information that you need, and we'll let the ATAA know that you are coming on the night. So obviously the topic for the night is going to get a little bit more interesting given the market at the moment, but I did set the market, or the topic for the night, in an uncertain market. What type of trader are you? Now, basically you can say that any monkey can throw a dart and pick winning trades in a bull market. However, only real traders can manage the best place to enter and exit, so they achieve less losers and more winners. So why is it that so many people fail at being consistently profitable, especially in times of uncertainty? Now, I'm probably going to adjust my presentation a little bit given what's going on in the marketplace, and so, but given the market right now, it really is going to be a fun night. It's going to be entertaining and very educational, I promise you. So remember to get your details in. You do need to send us an email to info@wealthwithin and title the email live presentation, and remember to put your contact info into the email so we can send you the details and then pass that on to the ATAA. So but now I think it's time to get into the subject for tonight's show, and that is, does mass panic on the stock market spell opportunity? Now, the biggest mistakes people make is to look at what's happening now rather than to look at two things. Now, the first of that is what has occurred in the past, and the second is based on what has occurred and how it unfolded, so that can give us an insight into how it might unfold into the future. Now, part of what Janine and I spoke about last week is that a human nature does not change. After all, how can we as a society go from donating millions of dollars and doing everything we can to help those people in the bushfires one month to fighting toilet rolls the next month? I mean, fear is a powerful motivator, and when fear is around, logic pretty much goes out of the window. Now, humans are very predictable simply because we are habitual. We go to work at the same time, we eat the same foods, we pretty much do, one day is pretty much similar to the next day, and en masse, that makes our society very, very predictable. And when it comes to the stock market, fear and greed dictate our behaviour. Now, people watch YouTube or visit chat forums in order to get the latest tip on what to buy out of greed. As they desire to make money, then they are fearful if the stock falls. Now, to me, knowledge is the enemy of fear. Now, gambling along with Tats Lotto and other games of chance are rampant in our society, as people really do want to get rich quick. But as a society, we're also plagued by fear-mongering, as we're constantly bombarded with negative images and negative messages. Now, to understand what's going on, we need to look at the past, as the past will guide us as to the behaviour of the market that was apparent in a previous bull or bear market, and how it might unfold moving forward. The insights give us signposts as to what is highly likely to occur moving forward. Now, before I show you some of my charts, I need to remind you of a statement from Warren Buffett, who said, "Be fearful when others are greedy, and greedy when others are fearful." Now, I totally agree with Mr. Buffett. So let me ask you, are you feeling fearful or greedy right now? And my guess is that unless you're a student or graduate of ours, is that you are fearful. Now, if Mr. Buffett has said this a very long time ago, then why are the masses not listening either now or in the past? The simple answer is herd mentality, and this is why there is just no toilet paper in the supermarkets. So let's now get into some charts so I can share with you just what occurs in times like this, and then we can share with you what might occur moving forward. Now, I'll get the guys to bring up my charts and I'll move over to where I need to be, and I'll drop that down and I'll just go to where I want to go. Here we go. So this is the All Ordinaries. Actually, I'll show you the Dow Jones first before I show you the All Ords, because it makes a bit more sense. This is the chart of the Dow Jones Industrial Average. Now you can see here, if you see right over here, that's 1900 where my pointer is. So I have data going back to 1900. So if I scroll back on here, you can see here, this is all data. That's 1900 down on that left-hand side. That's the 1929 crash on the Dow Jones. And you can see here I've anchored off what's called a 54-year cycle. Now, there's markets move from low to low in cycles. We're very habitual as human beings. I know that I can follow you around for a week and write down everything you do, how you have your coffee, how you brush your hair, what you have for breakfast, and etc. But in the next week, I'll be in front of you, because as humans, we do things habitually. So therefore, what happens is because we as humans do things habitually, it also reflects in the market, because human behavior drives the market, not the other way around. And so by studying the market, we can actually study human behavior. Now, I know Janine joked a week or two ago about women's dresses go up, and then when the market's bullish, and they go down when the market's a little bit more bearish. But again, social moods dictate the trends of the market. So looking at this, we can see here, if we go back to the chart, so I've anchored this 54-year cycle off the low in 1932. Now, remembering that our market had a low in did the 1929 crash as well. So we were down. Our market had a low in 1931. Not 32. But if we go back, you can see here now, that's the 1987 crash, and it looks like a little blip on the radar, doesn't it? It doesn't look too big. But if I expand it up, you can see, if I put my pointer on, you can see that's October 2007. So that was the end of the 54-year move, this big move from low to high to low. Now, like everything in life, everything's made up of smaller movements or smaller cycles. Now, I can't get into this a lot. Some of these charts and things I'm talking about is what I talk to our advanced people about, and we teach our advanced students. And markets do move from low to high in regular fashion, in smaller time frames and in larger time frames. But you need to understand that larger time frames are far more dominant. They're like the bullies in the playground. So they'll push the market round and push the smaller time frames around. So they'll make a bullish market bearish if a larger move is coming through. That's what happens. And so therefore, that's all I'm seeing right at the moment. I wasn't expecting a larger move to happen till a little bit later, and neither was Janine. But if we expand that out, this blue is called the 18-year cycle. There's 3 18s in 54, and it's very much what we see in the market is it makes 2 to 3, 1, 2, 3, or 5 moves in those bigger moves, in those bigger cycles, almost like Fibonacci numbers within that, or in multiples of Fibonacci numbers. Now, if we're looking at this, we can see here that the All Ordinaries Index from 87 came down. That's the GFC low in March 2009, and it was just a little bit late. It came in a little bit later, but that's the first move out of a 54-year cycle. So right now, we're in the second move out of a 54-year cycle. So the next big major low is not due. There's that point there is 2027. So people have been asking me why I've been saying the bigger move down is going to be sort of mid this decade. That's why I'm saying it. So if we go back and look at the Dow, you can see here there's a little move down in here, but it's gone bullish after this midpoint. Here, we're just in that midpoint, just past the midpoint. That's why I thought we'd had the midpoint of this move, because the Dow came into December 2018 and so did our market. But then we've had this other pullback. So I am quite confident our market will return to being bullish very, very soon. So let's have a quick look at our market. Now, this is a chart going back to 1982. There's the 87 low. Here's the 18-year move, and you can see here the low for the GFC here. You can see here the halfway of the next one, and it did come down here. That's the one where it came down 15% into December 2018. Now have a look at this. This is the halfway mark of this first 18-year move out of this low. And you can see a 21% pullback. And then the market rose up 55.8% through to that high in June 2001. And then by the time it finished the GFC high in November 2007, there was 211.2% rise. That's why I'm thinking our market is having a bit of a low. Now, am I discounting the market could go lower than what it is now? No, I'm not. It could go lower than what it is now. What I'm suggesting is history is telling us that we were due for a low. Now, I wasn't expecting this next major low out for another probably late this year or into next year. I was thinking the low would happen. It's just happened a little bit earlier than what I was expecting and what Janine was expecting. And that's okay. But what I also know is if there's a big move down in the middle here, that means the move out is going to be very, very bullish. Now I want to show you a couple of other things. Now I brought up if I go to, this is a chart I did for a presentation quite a few years ago, and the source was from AMP Capital Investors. Now I've just added a little bit here, but it's saying bear markets in Australian shares since 1960. And you can see here how we've listed them through here, and that was the end of their data through there. So you can see the months to reach the low was the average month down in a bear market was 15 months. The average percentage fall was 30 months. The months to make a new high, so go back above the previous high before the fall, it took 41 months to get above the previous high, and the percentage gain in the first 12 months is 32%. So when the market is very bearish, the gain out of it's going to be huge, and that's really what I'm suggesting right now. Once we find a low, the next move out is going to be big, and you're going to do very, very well. But you can see here falls 22, 23, 20%. There's 32, 21, 23. Now, the GFC went from November 2007 to March 2009. It was 16 months. It was 1 month longer than average. It was a little bit deeper. It was 55.6, not quite as deep as 74, and I'm going to show you that in a second there. But it took 124 months to get back up to the all-time high. So that's from the low in March 2009 through to the all-time high that happened only a few months ago, and the move out of that was 60%. So it's a pretty big move. Now we've seen a subsequent bear market, or in almost a bear market here in March 2015 to February 2016. So 4 years ago. It took 11 months, fell 20%, took 14 months to get back up to the high prior to where it fell, and it made 21%. So it's a nice big move out of that. Now, 11 months to make 20%, we've done it in 2 weeks. That's really abnormal. And if you go back and study the biggest fall that I believe we've had back in October 2008, it was, where our market fell over 7% in 1 day. That was right near the bottom. If I go back onto here, onto my All Ords chart, and we look at October, and I'll go to a daily chart here, and we bring that up. And I go to a daily chart, and let me look at 2008. Let me just go here, so you can see here. So this is 2008 here. So these are the big moves down into the GFC low. So November was nearly the low here. and obviously here is the final low in March 2009. But you can see some of those moves down were quite big through this time, and as the media is saying, well, hey, we had a big move down of 7% in that time. But you can see here, all during the GFC low, there was a retest. That was the high. It came down, it moved back up again, came down, moved back up again. If we go to what we're seeing today, if I scroll back over here, and if I bring it up wherever it is, all we've seen is a downward move, other than this tiny little bit, which is not enough. So what we need to do is look at this in context. Now I want to show you a couple of things. Here's an image that I used in a presentation many years ago. Wall Street plunges around at 90 points as panic replaces greed. This was in July, 21st of July 2002, and the journalist said, "No one's safe from US carnage, hang on to your hats, fun or horror, depending on whether you're a buyer or seller, it's just beginning. If you're neither, don't think you'll escape. Your superannuation fund is about to take a panic." That's this words here in this article here. Now if we go back to July 2002, let's go and have a look at that and see what was going on. And we go back to, where's 2002? We're almost there, little bit further. Here we go. So 2003, here's July 2002. This is a daily chart, so that's July 2002. It's almost near the bottom. So when you're getting newspaper articles like that, it's really starting to be a big signal that the bottom's happening, because if we look at the moves from there down, from roughly from there to the major low, you can see there was only another 8.4% over the coming 6 or 7 months. So there's not a lot of movement after that article was out. And this is why you need to be careful about what you're doing and what you're reading. Now this is some of the lows here from on our market. This is the All Ordinaries Index from 1968, and you can see here 38%, 59%, 40%. That's your 87 low. Down into 91, it was 32.8%. So these are some of the stuff I work with on our students and how they understand the market and how they unfold. And taking you through to the next one, this is from the 87 crash. 32.8 was that one I was just talking about. 22%, 17, 23, 42, down to this point in time in 2008. And obviously it fell a little bit further into 2009, but at the time I snapshotted that chart for our students to talk to them about what was going on in the GFC and how they could handle it. It had only fallen 42.8%. But the important thing is the market does move down, but you can see here how it moves up beautifully outside of every single one of them. And there's a lot of other things that I'm doing with our students to helping them understand. But I was chatting with our assessment team today, and I said to them, "How are you going with all the students? Are you getting any more emails or anybody concerned about the market?" And they said to me, "Dale, we haven't had one email of any student that's worried about the market. In fact, they're all telling us they're so calm about the market, and for the first time, you know, in their life when something like this is happening, they're more rational because they understand what's going on. They understand what to do." So to me, this is where knowledge really is the enemy of fear. So where do we go to from there? Right now, I do think our market will bounce. How far it bounces, how long it takes, how far it goes will tell me what it will do more medium to longer term. I am still expecting another move down, which may happen. So I still do need to expect that might happen, but you never know. Now, what we've done in the past, Janine and I have actually spoken about signposts that you can watch out for to alert you at market peaks and troughs. Now, one we did was the 18th of February's live show, so you might like to go and have a look at that, and where we mentioned that large amounts of leveraging is a signal that the market is peaking. We also talked about record levels of investors into managed funds. Now, basically what occurs at market tops is what Mr. Buffett suggests, in that the masses are greedy. Now, let me ask you, have the masses been greedy lately? And have they borrowed to invest? And have they been rampant in investing or not? And to me, the answer to all of that is no. So that suggests to me that the market isn't peaking because we haven't seen that. We haven't seen over borrowing. Now, please don't get me wrong, the coronavirus does have the potential to affect the world economy. What the charts are telling me is that it's not time to be fearful, but rather time to get mildly excited and wait for the opportunity that will prevail from the current downward move. Now, to me, you know, some people out there might go, "Hey, Dale, you're being a little bit silly here. This is happening, that's happening." And what I know is, having been trading and working with investors and traders for well over 2 decades, is that volatile times don't last very long. and neither do uneducated traders, and because they tend to make fearful decisions. And to me, now's not the time to panic. Now's the time to learn. Now's the time to sit back and watch what's happening, and then start to get into some really good stocks at reasonably good prices, because I think the move out of wherever that is, if we have the bottom today, whether we're having it tomorrow, whether we're having it next week or next month, or whether it doesn't happen till June, it's irrelevant to me. It's what we do and how we're managing our portfolio. And again, people who bought my book aren't panicking. I've had a lot of emails from people saying, hey, for the first time I'm calm about the market because I do have rules. It's the ones that are panicking, those ones who we talked about a few weeks ago about having a behavioural bias. You know, and yes, I could have had a behavioural bias because I didn't think the market would be affected this much. Whilst I got the direction right, I didn't get the speed right, and I didn't get how much it was going to fall right. So shoot me, guys, I got that bit wrong, but it doesn't mean I'm not going to be wrong next week or next month, because Janine and I are generally right most of the time. But let's now get into the chat, or back into the chat as they say, and have a look at some of the questions that you've got for me. Now, the next question we have is from Todd Martin, who says, hi all, some of my stop losses have moved in and out of me enacting them on a daily basis, but seem to hold up within a day or two. Do you enact stocks by day, week or month? Really good question there, Todd. It really is a case of what's your testing telling you. And we have various different filters on stop losses and also on entry and exit triggers as well, because you've got to separate stop losses from entry and exit triggers. Some people think, well, entry and exit is the same as a stop loss. No, it's not. A stop loss is just a protection of capital in case a share you own or you bought falls below your buy price. Everything else is an exit strategy from that point of view. So looking at stop losses, you could set it on a move through a certain level. So if it trades through a certain level, you exit, just immediately exit. You can have it if it closes on any day below that level, any week below that level, any month below that level. Your choice. But how you set it, that will depend on the stock you have and your trading strategy around that stock. Because some stocks are more volatile, like a BHP and a Rio, and some stocks are a lot less volatile, like Telstra or CSL. So therefore you might have different stops and different rules around that. You can't just arbitrarily go black and white, going, that's the rule that's going to fit. And this is why I find a lot of traders make big mistakes, because they get an like a black and white rule and go, that's it. But that's why we talk about the art of trading. You need to understand how the market's unfolding, the personality of the stock, and have rules for that stock. And our students tend to have smaller watch lists, but they know those stocks because they know how they run, what the stop losses are, what best stop losses are used on those stocks, what are the best buy rules, what are the best sell rules on that stock, how it's best to manage that stock. And by doing a little bit of extra work, you'll make far more money. But thank you for sending the question. It's really, really good. The next question I've got is from Sushi. He says, I can't say your name, sorry. YM Saucy. YM Saucy. That's what the guys talked in my ear. YM Saucy. He says, can I buy ASX shares but selected company? Yeah, you can. You can buy anything listed on the ASX that you like. You just set up an account with your broker. If you don't have an account with a broker, I just set one up with your bank. That's pretty much what I would do. And then you can choose the stocks that you'd like. But given you're asking these questions, I suggest, it suggests to me you're very, very much a beginner. So what I would suggest you do is you go to the ASX website, asx.com.au. They've got some really good basic information there on what the market does, how to find a broker, what shares are, those sorts of things, a lot of what is. They won't teach you to trade like we do, but they will help you out understanding some of the market, but great education from that. The next question we got is from Michael Sopal, who says, hi Dale, my question. I just got out of hospital. I hope you're all right, matey. And then I see my portfolio at a 34% profit loss. Because I didn't have any knowledge of the markets at the time. I'm thinking of just holding. What happens if you miss the stop loss you set for unforeseen reasons? Again, it's how long's a piece of string, matey? That's really the answer to that is you need to decide that, because I can't blanket say just sell out and just get rid of them, because I don't know the stocks, and also that's financial advice, and because this is YouTube, I can't be I don't know who you are, and I can't give you proper advice on that. I'd be looking at the stocks that you own. If you've got really, really good stocks, then you know, you might look at them. Generally, when Janine and I get a portfolio coming in from somebody who's not a student of ours, like a brand new portfolio coming in for us to manage, we do find people do have stocks that are 30, 40, 50% down. We don't immediately sell them for those people, even though they're below what we would have traditionally sold them. What we do is tend to manage them out. So what we do is have a tight stop loss underneath them, and while they're rising, we keep moving with that and we move the stop loss up with it. You might like to try that from that point of view, but you just do need to set an arbitrary figure. Now, a figure underneath those stocks that if they do start to fall further, that you do have an exit point that you've chosen that you think's reasonable for you. But then also, as I said, maybe have a trailing stop loss up to move underneath them as well. The next question I've got is from Stephen Palmer, who says, been watching for months. Thank you, matey. And Dale did predict a fall. Luckily, I pulled a large amount off the market, so thank you, Dale. That's my question. No, sorry, not my question. Thank you very much for saying that. That's really kind of you saying that. Yes, I have been saying the market's going to fall. What I got wrong was the speed and the depth of it, so shoot me on that one. But as I said, we generally get it right. But the next question's from Caleb. I think Caleb's a trading mentor student. So hi, Caleb. I think I've got an email from you, some back testing you've done. So I'm going to have a look at that hopefully tomorrow for you, matey. He says, hi, Dale, thanks for the wise words. I got stopped out of all my positions over the last week. Looking to get back in on stocks like Goodman Group, but with the volatility, should I take an entry if one arose? Now, let's go and have a look at Goodman Group. I'll bring it up. I'll put my glasses on. As I said, it's a little bit disjointed today because Janine's not here and we've got all these little technical issues, but let me bring up Goodman Group. But hopefully you enjoyed a little bit about my take on why you should be more excited about the market. Do what Buffett does. I mean, nobody can argue with Buffett. If he says don't be fearful when the others are greedy, then be fearful when others are greedy. And if he says, you know, be greedy when others are fearful, that's what you should be doing. You should be thinking about how I can profit from this move. But let's bring in Goodman Group, GMG. And let's have a look at that. You can see how it's fallen away a little bit, so it hasn't given us a technical exit, but I don't know where you've entered. Caleb, I'm not sure when, but right now it doesn't have a technical exit on me. If you've exited on just having a stop of from that high, then obviously you can see it's fallen 21%. It's down to 16.7%. It has been a really bullish stock, if you see there. It's been beautifully bullish. Its all-time high is way back here. I do like Goodman Group. I think it's a good stock. Right now, I'd just be staying out of it a little bit. It looks like it's finding some support around that $13 mark. If it finds some support and triggers your buy signal that we've taught you in the Trading Mentor course, then I wouldn't have any issues with you getting into that. Again, but I would set your stop losses again, because you know some people treat stop losses as a negative. I actually treat it as a positive, and I teach the traders from our course. I said, learn to love getting stopped out, because the more you learn to exit, the more money you will actually make. And that's probably sounds like an oxymoron to a lot of people, but you need to get used to selling, because if you can, there's an old golden rule of trading: let profits run, cut losses short. So if you're letting losses run and cutting profits short, then you're not going to be very profitable. That's exactly how most people trade. They cut their profit, they get 10% and they get out, but they'll suffer a 20, 30, 40, 50% loss, and that really kills their portfolio. So just look at your rules, matey. Don't be in a hurry. Just be really patient. Trading the market will teach you patience. If you're not already, you will be, but just stick to your rules, and happy to help you out there, as I said, on our support as well. The next comment is from Jacob, who jokes, I hope Woolworths pay a special dividend because all of the toilet paper and pasta that's been brought. Yeah, so Coles is looking all right too, matey, on that one. So thanks for doing that. I was going to bring on a toilet roll as a bit of a joke, saying here's the next best investment. Bitcoin's now gone. Now it's toilet rolls. You know, toilet rolls go up 100% in a week. So buy toilet rolls from now on. Because I think it's just pretty crazy, people buying lots of toilet rolls, and I can understand hand sanitizer, but toilet rolls. The next question we got is from Big John. Welcome, Big John, who asked, hi Dale, thanks for your ongoing videos. Wondering which 3 stocks do you see as the market darlings of the ASX? Geez, mate, I'm not going to give you any tonight, because right now where the market is, and you need to understand what you're doing yourself, rather than me going, I like this stock, that stock, or that stock. You know, to me, I do like stocks like Combank. It was hit really, really hard. I do like Telstra. It was not hit as hard. But you know, A2 milk's looking all right. But again, it's what I'm thinking right now, and to me, just to give you 3 stocks, you need to determine what kind of portfolio that you need, what's your time frame, short, medium or long term, and then you need to fit stocks around all of that, because it's not just about, all too many people think, just give me the best stock and I'll make money, and that's not the case. I could give you, and I'll give you an example. For many years, for about 4 or 5 years during the bull market from 2002, Janine and I were writing a report where we would tell people what to buy and sell, and actually we had it into portfolios, 4 different portfolio styles that people could choose from, and all it was follow the bouncing ball. If we said we bought this stock, you go and buy it. If we said sell this stock, you sell it. And what we found, and we gave people 100% money back guarantee if they didn't make money, and every single person that asked for their money back guarantee didn't follow what we said. And at the time we had a 92% success rate in picking stocks, yet people still were able to lose money on their trading because they second guessed everything. They wouldn't sell when we said to sell, they didn't buy when we said to buy, they bought later. They did a whole range of silly things. So it's better to educate yourself and understand how to construct your portfolio and what stocks suit that type of portfolio and suits your trading style or your investing style, and it's congruent with your risk level. And that's really what you need to do. So if you haven't read my book, get out and buy Accelerate Your Wealth and learn, and you'll be able to create your portfolio. The next question I've got is from Steve Gray. Some awesome questions tonight, isn't there? The next question is from Steve Gray, who asked, did the market drop down lower all of a sudden because there was an opportunity to let it fall? Example, coronavirus, a bit early, but hey, an opportunity is just that. Look, I can have a lot of speculation around why the market fall. It's a lot of short selling, I believe, happened on the market, and a lot of extra short selling. But I'll ask you the question, you can't sell a share until somebody buys it, so who's buying? Think about it. You cannot sell a share on the Australian Stock Exchange unless somebody else buys it. So who's buying? And why are they buying if the market's melting down? Now, there's a lot of short sellers out there pushing the market down, and I think this is where not just the Australian government, but world governments need to look at this, because you've got algorithmic trading, you've got hedge funds, you've got all this short selling going on, all these leveraged things that aren't necessarily about buying a stock for an investment, for creating value, buying the company for it to rise in value because it's making more money. They're making money out of thin air, if that makes sense. They're just buying something, selling something very, very quickly and creating. And their argument is we're creating liquidity, but they're not really creating liquidity. In my book, and I think the governments need to look at it. I know during the GFC the government in Australia stopped short selling on the marketplace. Now, I'm not suggesting that's ever going to happen soon, but I think we really do need to look at this, and I also think this is one of the tests on exchange traded funds. Now, a lot of you people who've been watching know that I'm not a huge fan of exchange traded funds, and I do cop flack from financial advisors about that, because they're saying, you know, if you have an ETF on an exchange, then you're very well diversified. And I reckon that's the biggest load of BS I've ever heard in my life, because if you buy an exchange traded fund, that's an index fund based on the XAO or the XJO or the top 200, top 300, whatever that is. You're buying one stock code from one exchange with one company behind it. That's it. And a lot of people don't understand that when you buy an ETF, the company with that ETF is actually creating those shares at the time. So they're providing the liquidity to that. But so are they going to want to buy it back if the share market's in free fall? And are they going to make that fair? So I don't know. I need to do a lot more research around what's going on at the market at the moment and determine whether ETFs has caused a little bit of people have been panicking about their ETFs and just selling out heavily of those, causing the ETF fund managers to sell a lot of stock, which has exasperated this fall. Something's caused it to go further than what I expected, because when you go back over hundreds of years, falls like we had yesterday are seriously unprecedented. Like, it's rare to see a fall of 7% on the Australian market. Very, very rare. And it's like I couldn't tell you, other than sort of the 29 crash, I can't tell you that where our market's fallen 20+% in a matter of days. And we're talking, less than 2 weeks, it's fallen 20%, or around 2 weeks, 20%. So there's something pushing that. And it may come out, the government may have a look at it, ASIC may have a look at it, the ASX may look at it to see what was going on there, what's pushed it around. Because what I know is at the big end of town generally win, and the average punter generally loses. So, but good question, Steve. Thanks for asking it. Hopefully my rant is not too bad on that, but as I said, sometimes I get a bit hot under the head with mum and dad getting beaten around with the big end of town pushing the market around. But let's get on to the next question. It's from John, who asked, are you weighted towards cash in your managed account waiting for confirmation of a trend line? Absolutely. We were already, for a lot of clients, we'd already been selling. Like we kept saying to you, we're not buying. We'd said quite a while we weren't buying stocks for the last sort of 6 or 8 weeks. We were slowly selling as stocks were presenting their sell signals. We were selling, and that's really what we do. Personally, I was 60% cash. I believe, I can't remember exactly, I was about 60% cash. So the times you are fully invested, times you're fully in cash, and then you have swings in between those two, between fully invested and partly in cash. It just depends on the style of investor or trader you are. But I know most people, especially when they're going to, into the industry, they're getting fully invested pretty quickly, and that's how it works. Now, the next comment or the next question or comment we've got is from George, who says, Dale, your direct prediction confirmed my thoughts. Okay, my direction prediction confirmed my thoughts. 0 loss on my super from this drop, not bad. Well done, matey. You can buy me a beer. Make sure it's a Corona. I'll have a beer one day. Now, the next comment's from David A, who says, still shocked how well CSL has held up. Was hoping to get in when this blows over. Well, it's up to you whether you buy into CSL or not, but it really has held up. So let's go on. We'll bring up CSL and have a little bit of a look at it, because it has been a phenomenal stock to hold. And I'll put a couple of other stocks in for our next couple of questions as well for a couple of people. Wish Janine was here because I wouldn't have to talk so much, hey? And let me bring out the next one was REA. And we'll have a look at A2 Milk as well, I believe. Well, that's another good looking stock at this point in time. And A2 Milk. So let's look at CSL. So obviously he's asking about possibly getting into this stock. And you can see how beautiful this stock is. It really gives you any cause for concern. It fell away through here into that low into November 2018 to 25%. So it does have some bigger falls. Currently the fall from that low to there was 20%. It's now only down 9 or 10%. It's really up to you whether you get into this stock or not, but that looks nice and strong to me at this point in time for a stock. And if you had that in your portfolio, we have it for our clients, I believe, from memory. I still think Janine will confirm that. I've forgotten. I've been looking at lots of stocks at the moment. So I'm not 100% sure exactly. We've been selling a few, as you know, from our stop losses as well as protecting capital over the last couple of weeks. So, but this does look really, really good. The next question we got is from Seb, who asks, hi Dale, what do you think of REA and A2 Milk to buy now? The answer right now, basically you're never going to get me to say tonight to buy now. That's not going to happen tonight. And I don't tell people to buy or sell on this show, because at the end of the day, you need to have rules around what you're doing, where you're buying, why you're buying it, and how you're going to manage that. So I'm going to have a look at the stocks and tell you what I think of them. REA is it's been a little bit bearish like CSL. It's fallen a little bit heavier. Right now today it's obviously moved up nicely. So if we put our little tool on here, you can see how it's fallen down around about that 20. I'll put my glasses on so I can see it. 24%. It's now closed up around 16.9%, but I wouldn't discount that it stopped moving down, but I wouldn't also discount that it hasn't stopped moving down. So it's really too early, because you could be catching a knife. And this is what, and I'm not trying to be rude to you, mate, this is what the amateurs do, is they jump on shares because they're a bit cheaper, hoping to make money out of it. It's called what I call, or affectionately called, the buy and pray method. Again, I would rather see a stock rise 10, 20, 30% off a low and get in late knowing it's going up than get in early hoping it's going up, because traders trade on confirmation, not speculation. Otherwise, you may as well go to the track and bet on a horse or a dog, because you might have a better chance of winning, because you're going to get it wrong a lot, especially in markets like this. So whilst I'm expecting the market to bounce, it may only bounce for a few days or a week and then turn around and go the other way, and you're caught in a falling knife. But right now, it's not telling me to buy into this stock. It's saying to me to watch. It's looking hopeful, but it's not telling me to buy. A2 Milk's pretty similar to that. Hasn't really been affected, as you can see. This is this week. It pushed right down, came right back. It is nice and bullish. So if you're going to buy a stock, this would probably be more likely what I would be buying rather than anyone else, because it's been very, very resilient. I do like it at this point in time, and I don't think there's any reason why it shouldn't break through its previous all-time high. But again, as I've said before on A2 Milk over the last few months, as it came down through here, a lot of people are saying, should I buy in now? And they're buying in on the premise that it might do this again. It might really skyrocket again, where it goes up, a ton of percent. It says 700% from there, and they're seeing that. So people remember that it rose 112% between October 2018 and July 2019. They remember it flew up here. It's not going to do that again. So it won't get those phenomenal rises, because now it's around that $17 mark. It's a bigger share. It's not $2 anymore. And it's also the broader markets looking at this as well. So it's probably not going to be doing those sort of 100+% in a year. So don't expect it to do that. But good looking stock at this point in time. Now, the next question we got is from, it looks like Miff Joseph, who asked, what sector should we be looking at going forward for 2020? I covered that in the early part of there. I said some of the sectors that I was looking for the ones in that first part of my recording when I was talking about the sectors, is looking at the ones that haven't fallen away as much for more immediate term buys, and so those sectors that hadn't fallen away. Energy has fallen the worst so far this year. Energy, materials, not so much financials, but energy and materials have fallen a lot heavier. So I would be looking at those to find bottoms for later on, maybe a few months down the track, but they're the ones I would be looking at the moment for the opportunities. Now, the next question we got is from Andrew M, who says, I'm assuming the majority of your stocks have had their sell triggers. Are you waiting for the volatility to die down before re-entering, or waiting for another big down day to jump back in? We never wait for a big down day to jump in, matey. That's never going to happen. Yeah, we're waiting. We wait for the dust to settle. And again, it really gets back to what I was saying before, is people just trying to catch falling knives. Just settle down, guys. It just go on holidays for a month and come back. Go into a coma for 6 weeks and come back, and then it's. I'm not having a go at you, matey. Please don't think I'm having a go at you, but don't try and get in fast. And that's what I'm saying. If you're in a rush to get into the market, you're in a rush to lose. And that's what I continually say, is sit back, wait for the dust to settle. And I think I talked a bit about, I was chat with Jim Beach a few weeks ago, where he was saying to me, Dale, you sound a lot like Warren Buffett, who says, sometimes you just need to sit on your hands. Because I actually said, I'm just sitting on my hands right now. And that was a couple of weeks ago. Now's the time to sit on your hands and go to the beach, read a good book, forget about too much, and wait for the market to settle, then come back in again, because the chances are you're going to get it wrong. And chances are you're going to buy a stock that's not going to look after you very, very well, because you're trying to buy cheap, and you might buy something that's falling quite heavily. So, and I think I've said it several times tonight, now's not the time to be buying shares. Now's the time to be sitting on your hands, taking it easy, taking 3 deep breaths, and being rational about it all. So just take it easy, guys. Now, the final comment we have for tonight, wow, is that gone that fast for the show? The final comment we've got for tonight is from, have you subscribed? That's the point. I'm getting sweaty under the armpits here, answering all your questions, and what you can do is hit that subscribe button and say, Dale, thanks for the show, thanks for supporting us, thanks for being that calm, reasonable head. And remember, hit the bell on the right of it and hit the like button. Hit that like button right now, and that shows the support for our channel. But the final comment tonight's from Les Brown, another new name I haven't heard. There's quite a few new names I haven't heard tonight, so welcome, Les. He asked, what are your thoughts on Nearmap? I like Nearmap. It's a nice stock, actually. I've liked it for quite some time, actually, so let's bring that up. And if the producers and directors and the people that must be obeyed in my ear, let me, we might be able to do another stock, but let's see how we go. Nearmap has fallen quite heavily, as you see, but I do like it because it rose heavily. And it's a pretty good example of what rises fast will fall fast, but it's just falling back to its momentum. And what I mean by that, if if I just do my sort of little trendy line on here, you can see here most of the price action is along there. Now I've done a lot of that research on the All Ordinaries Index. Now I won't show you, I actually had it on my spreadsheet that I was showing a bit earlier, but I didn't have it on the tab that you could see. But I look at momentum in the marketplace. Now our market rises, it currently runs at about 1 point per day. So 1 point up every day. Prior to the GFC, it was running at over 2 points per day. But even at the high in February this year, our market wasn't running at that sort of level. It was running just over half of that. So that was telling me another reason why our market's just coming back to being normal momentum. And that's all this stock is doing. And that's really why I was starting to get excited about it, because I think it might find some support pretty soon. You can see how it's pushed down this week, or the Monday and Tuesday, come right back up again. Again, I'd wait for it to find some support. You could get a nice little trend line down on there if you've read my book. From there, but again, wait for it to show it's starting to rise. Don't just jump in because it rises 1 or 2 weeks. That's what people do that are catch falling knives. They see a stock move up for 1, 2, 3, 4 weeks, they move up 10 or 20%. They jump in thinking it stopped falling, and then all of a sudden it turns over. And you guys haven't experienced that, have you? Yeah, you have. Some of you have, I know that. And what you do is you really need to take care. But last and final question, I've just schmoozed the guys because you must have hit the like button. Hit the like button again, hit the subscribe button, guys. But the final question is from Steve P, who asks, looks like Westpac has come back closer to ANZ and NAB. Yeah, all of them look CRAP, don't they? And where's the swear jar? I had $19 as the entry point for all 3 banks a week ago. However, due to the last 2 days, I think the entry point will be lower. It'll be a hell of a lot lower, matey. Those 3 banks, as I said, my preferred bank is CommBank at this point in time. It was hit hard, but if you go and have a look at, let's have a quick look at Westpac there. Look at that one. Here's CBA. Look at NAB, and you can see them, and NAB and Westpac don't look very good at all. So there's NAB. It's been going down since September. So again, that's what I'm saying. If a stock's already moving down, and people would have been buying NAB in here, and I know people asked us about NAB in here, and they would have been buying here only to get caught into this. If we go to CBA, see how much more bullish it was. Through here, it was risen past all of these highs right back through here to 2015, and I think this thing's going to be the better bank. And Westpac, again, you can see how Westpac, again, same as NAB, fallen since September 2019. Its high was way back in 2015. Right now it doesn't look healthy at all, but again, looking at the bigger picture, it's just coming back. If I draw a trend line across there, you can see here that it's probably just around about that momentum where it comes back to. So maybe the banks will start finding some support at this point in time. But I know you said $19, but don't ever set a price target like that, matey, because that will see you have mistakes all of the time. Always let a technical entry give it to you, not a price level based on some other thing where it may be a support level that you think. Every man, woman, dog and child knows support levels, and so that's why you see stocks get pushed through them, support levels, and resistance levels, they get pushed them and only to retrace again. And so you need to have some solid technical rules around that. But now it's the end of the show. Wow, how fast was that? And a little bit disjointed. I do apologise for the start because we did have a bit of a challenge there. But this show this week, hopefully it's expanded your thinking and helped you understand a little bit. And next week, I'm not really sure what we're actually going to do, but I do have some ideas that, again, will stretch your thinking. So I do hope you enjoyed the show, and thanks for participating. But if you'd like to see the show grow, remember to put it on your social media. So we are here to help you, and Janine and I give our time freely to help you. And as I said earlier in the show, we don't care whether you buy or sell. We don't make any money out of it. So it's really, we're very much here as apolitical in that respect. We're distance, we're third party people. We're helping you, trying to understand the show. So remember, share it with your social media on Twitter, Facebook, you name it, all of those sorts of things. Also remember, we do this every single Tuesday night, so remember that. But as always, we're happy to receive your questions, so send them through to info@wealthwithin.com.au. Just type Wealth Within Live in the subject line. So, but remember, we do these shows every Tuesday night, Tuesday 7 to 8 p.m. So make sure you put that on your calendar for next week. But again, thanks for watching to the end of this show, and putting up with my bit of disjointedness at the start, but that really does bring us to the end of the show, and we really do hope you enjoyed it as much as I have bringing it to you. But as always, thanks for joining us, and we'll hope to see you again next week. For now, goodbye, good luck, and good trading.